Hello guys, today we are going to talk about the three most important financial statements which are used to analyze the financial performance of a company. Let's start with the P&L statement where P stands for profit and L for loss. This statement is also known as the income statement. This statement provides information about the revenues, expenses and net income for a year taking into account the depreciation cost, finance cost and taxes incurred. It is used to analyze the operating performance of a company and give an idea of the profitability of a company. Now let's take an example of a draft income statement where we will see some of the general entries. First entry is revenue, which is 100 lakhs. This includes the operating income and non-operating income. The next is the cost of goods sold, which is 55 lakhs and generally makes up most of the costs incurred by the company. In this case, it is 55%. Operating expenses is 20 lakhs, which includes selling, general and administrative expenses, salaries, etc. Depreciation cost is 5 lakhs. As we use the fixed assets, they generally lose their value. This depreciation cost is the reduction in cost of fixed assets. Finance cost, which is also known as interest cost, is 5 lakhs, is the cost paid for loan taken by the company. Tax is 5 lakhs, which is as per the corporate tax rates. Then finally, the net income, which is also known as the net profit, is 10 lakhs. All this draft income statement, this completes our income statement. Now let's move to the next statement, which is the balance sheet. This is different from the income statement in the way that it is created as per information at a point in time rather than for a particular year. It provides information about the assets, liabilities, and owner's equity of a company. Assets are what a company builds in due time. Liabilities are what a company owes to its various stakeholders, and owner's equity is what the company owes to its owners. Assets can be fixed and current assets, and liabilities can be long-term liabilities and current liabilities. Let's take an example of a draft balance sheet where we will see some of the general entries. The fixed assets include land and machinery with a value of 40 lakhs each. The current assets include inventory, cash and receivables with a value of 30 lakhs, and 10 lakhs respectively. The current assets are different from fixed assets in the way that current assets have a time span of a year, whereas fixed assets have a time span of more than 1 year. The total value of assets with a company is 150 lakhs. Moving to the liability side, we see that long-term liabilities include bank loan and bonds, and current liabilities include the payables to suppliers, the payables to the bank loan, and salary payables. The current liabilities and long-term liabilities are different in the way that current liabilities are to be paid within a time span of 1 year, where long-term liabilities are to be paid with a time span of more than 1 year. The total liabilities of the company is 85 lakhs. Moving to the equity side, it contains shareholders' funds and reserves and surplus. The total value of the equity is 65 lakhs for the company. There is one thing to keep in mind. The assets are always equal to the sum of liabilities and equity. Never forget this rule. After seeing this part, this completes our balance sheet so that we can move to our third statement, which is the cash flow statement. It is important because position of cash is very critical for a company. It provides information about the sources of cash for the company, which mainly are operating activities, financing activities, and investing activities. It is prepared for a particular year like that of the income statement. Now let's see a draft cash flow statement. Starting with the operating activities, it contains cash received from operations and cash paid to suppliers and employees, so that we are able to know that the net cash flow for the company from operating activities in this year is 25 lakhs. Moving to the cash flow from investing activities, we see that there's a negative cash flow where the company has invested 10 lakh rupees in addition to machinery, so that the net cash flow from investing activities is minus 10 lakhs. Finally, moving to the cash flow from financing activities, we see that the company has gained 20 lakh rupees from a loan and it has paid 10 lakh rupees in this year towards the loan, so that the net cash flow from the financing activities is 10 lakh rupees. If we assume that the cash at the beginning of the period is 5 lakhs, so The cash at the end of the period is 30 lakhs. How has this value has come? By taking into account the values of net cash from operating activities, investing activities and financing activities. The value of 30 lakhs has come, so that the net cash at the end of the period for the company is 30 lakhs. This completes our cash flow statement and also a basic understanding of the three financial statements, that is income statement, balance sheet and cash flow statement. I hope you like this video and I will try to bring to you better videos.